average operating income. So net operating income divided by average operating assets, while this is the net operating income minus average return on, sorry, minimum return on average assets. So let's talk about this. Let's calculate. The retail division of Zephyr Incorporation has average operating assets 100,000, and they are required 20% to earn those assets. So in current period, the division earned 30,000. What is the residual income? They are given the target to earn 20% of 100,000. So their requirement was to earn 20,000. They earned 30,000. So the residual income is 10,000, right? So formula is net operating income, which is 30,000 minus 20% on the average asset 100,000, which is 10,000, right? So motivation and residual income. So residual income encourages managers to make profitable investment, right? So that would be rejected by managers using ROI. So if you see the previous example in which they rejected the idea of increasing the return by 15%. So let's talk about this. Redmond Owning, a division of Wrap-Up Corporation, has a net operating income of 60,000 and average operating assets 300,000. The required rate of return for the company is 15%. What is division's ROI? ROI is net operating income divided by average operating assets if we are given. So net operating income is 60,000, right? And average operating assets are so what is the answer here? Guys, what is the answer here?
D20.
Well done. So the ROI says the company, is giving you 20% return. Okay. So Redmond Owning, a division of Wrap-Up Incorporation, has operating income 60,000. This repeated value. So if the manager of the division is evaluated based on ROI, will she want to make an investment of 100,000 that would generate additional net operating income of 18,000, right? So if they invested in that one, how much increase in income? 18,000, right? But they have also increased their assets from 300,000 to 400,000. So if you divide 78,000 divided by 400,000, answer would be, so would they accept this proposal? The previous situation was they were earning 20% of ROI, and now the ROI has decreased 19.5%, right? So would the manager approve this kind of investment? Answer is no, because the ROI has decreased to 19.5. But what if you evaluate on the basis of the company required rate of return is 15%. Would the company want the manager to make an additional investment? Okay, would you analyze based on residual income? Yes or no? So the required rate of return is 15%, right? On the additional assets, which is 100,000, and he is going to increase 18,000 operating income. Now you tell me whether we should adopt it or not. On the basis of residual income, it is giving us 3,000 extra residual income. Then yes. Right? On the basis of ROI, no. Right? So what will be the residual income? Total residual income here. The old residual income. The company is having a required, the income is 60,000, and they are required to earn 15% on the operating assets, which is 60,000 minus 45,000. So what is the residual income? Simple C. Right, guys? So now you tell me whether we should accept it. We just calculated this quick check that if we base our decision on ROI, then the manager should not accept this proposal. If we base this decision based on residual income, then answer is yes, we should accept this opportunity because this is giving us above our 15% minimum required rate of return. So that's how ROI and the residual income differs. So normally managers are evaluated based on ROI. So some big companies who do know these kind of concepts, they do include the effect of residual income. Right, guys? So that is the the important part here to understand that how performance is measured in decentralized organizations. So the residual income approach has one major disadvantage, that it cannot be used to compare the performance of divisions of the sizes. So we saw that residual income approach is very good, but it has a major disadvantage. Here we go. So we have a retail store and we have wholesale store, right? And we say that the positive number should be appreciated. If the residual income is positive, we should accept that. But the residual income do not include the magnitude. So here the operating assets of retail is just 100,000 and wholesale is 1 million. So required rate of return is 20%. So what happened here is the retail store, they just earned 30,000 and wholesale department they managed to earn 220,000. So both earned positive residual income, right? So which one is good? Retail is good or wholesale is good? According to residual income approach, both department evaluated the same. But remember, earning 10% from $100 investment is equal to $10 is very easy. But earning 10% from $1 million, which is 100,000, is really difficult and challenging job. If somebody did that one, it means he is really capable manager. So one big drawback of the residual income is that comparison of the different sizes we cannot compare based on residual income, right? So the residual income number suggests that the wholesale division outperformed the retail services. But if you see the ROI example here, you see that the ROI of the retail division, which is net income, 30,000 divided by the assets are, which is 30,000, while the wholesaler, they just earned, you see, 220,000 divided by 1 million, which is 22%, right? So if you compare based on the residual, you will say that wholesale department did well. Why? Because they gave us more positive number plus investment. If you have more money, invest in both retail and wholesale. But if you see on the ROI basis, you see that ROI of retail is 30% and wholesale is 22%. So what to do now? Can you compare those? Answer is no. Because residual income, approach cannot be used for comparing of different sizes, but ROI can be used to do that, right? Because your ratios can be comparable. Numbers are not comparable. Now, let's talk about the efficiency of production department. So this is just, we talk about the efficiency of the managers. Now let's talk about the efficiency of manufacturing department. So compute delivery cycle time, throughput time, manufacturing cycle efficiency time. Let's talk about these. What are these? So when the order is received, there is a wait time, right? So when the order is put into production, there is processing timing, inspection time for quality, moving time, and then queuing time, so that the time is, finally the product is sent to the for shipment, and then goods are shipped. So the process time is the only value added time here, because inspection time is very minimum, moving time is minimum. Now we have robotics, we have machines. Inspection time is done by computerized, computer technologies. Moving time is through computer technology. Queuing time, only thing is processing time here. So the delivery cycle is wait plus the throughput time. Throughput time is equal to processing time, inspection time, moving time, queue time, right? If you want to evaluate the manufacturing performance, evaluate based on process time, right? Because all the other things, they are quite negligible. So let's talk about here. If you want to calculate the manufacturing cycle efficiency, so manufacturing cycle efficiency is equal to value added time, which is process time divided by manufacturing cycle time, right? And manufacturing cycle time is basically throughput time. So let's talk about this. Our TQM team as Norton Corporation has recorded the following